Now, I'm sure most of you at some point in your lives have held an ISA, most likely a cash ISA, I would imagine. You may have held stocks and shares ISAs if you want to invest in tax-free ways, but really there are 4 types of ISAs you can have. There's the cash ISA, and those you hold with banks, building societies, and you can also hold some national savings and investment products. There are stocks and shares ISAs, which are probably the second most commonly known of ISAs. You can hold shares, unit trusts, investment funds, corporate bonds, government bonds. So there's quite a variety of different investment types you can hold within a stocks and shares ISA. There's a lifetime ISA, which effectively replaced the Help to Buy ISA, and you can hold that either as a cash ISA or as a stocks and shares ISA. And probably the most lesser known type of ISA is the innovative finance ISA. This is quite a complex investment ISA, but it means you can invest in more complex investment types such as peer-to-peer loans, so loans that you give to other businesses without going through a bank, and crowdfunding debentures, so that's investing in businesses by buying their debts. So as you can tell, that all sounds quite complex, so it's something you would probably only really dig into if you've got a lot of knowledge about it, and something that you would only do probably if you've utilised all your other types of ISAs or investment products and you're looking for a real sort of complex way to access those investment types. You can pay into each of those types of ISAs in a tax year. So if you wanted to, you could pay into one sort of cash ISA, one stocks and shares ISA, one lifetime ISA, and one innovative finance ISA throughout the tax year. But there is a limit on the amount you can pay into all types of ISAs each tax year, and that is £20,000. Now that's not £20,000 into each type of ISA, I'm afraid. It's £20,000 across all ISAs. But there is an additional limit on lifetime ISAs of only £4,000 a year. So for example, you could pay £11,000 into a cash ISA in one tax year, and in the same tax year you could pay £2,000 into a stocks and shares ISA and £3,000 into an innovative finance ISA, as well as the £4,000 into a lifetime ISA. So all combined, that hits your £20,000 ISA limit and your £4,000 lifetime ISA limit. So if you want to maximise your ISAs, you need to be looking at trying to get all your £20,000 in each tax year, which runs from the 6th of April to the 5th of April the following year. And those limits get renewed every April, so you can have a fresh allowance each tax year. So ISAs can be a really effective way to save tax-free. There are some criteria you must meet to be able to open an ISA in the UK. For cash ISAs, you must be at least 16 years old. For stocks and shares and innovative finance ISAs, you must be at least 18 years old. For lifetime ISAs, you must be over 18 but under the age of 40, and you must be a UK resident. So you must be living and working in the UK in that tax year to pay into an ISA. ISAs are called individual savings accounts, so you can only hold them in your name only or in children's names, but you cannot hold them jointly or on behalf of somebody else. There is a different type of ISA for children called junior ISAs or JISAs, and these are slightly different to the adult ISAs that we've just spoken about. These are for children under the age of 18, and the annual limit was recently increased to £9,000 a year. Junior ISAs can be a really tax efficient way to save for your children. Children must be under the age of 18 and living in the UK, and junior ISAs can be held as cash ISAs or as stocks and shares ISAs, and you can actually have one of each type if you want to. So parents or guardians open up the junior ISA for the child and they manage it for them, but the money is held in the child's name and it belongs to the child. The children can take control of their junior ISAs when they turn 16, but they can't actually withdraw any money until they turn 18. And there is a little bit of a loophole where children who are 16 and 17 can actually have a junior ISA as well as an adult cash ISA. So there's a bit of a crossover there where you can have a sort of a double ISA, if you like, that normally doesn't apply. Junior ISAs are available through banks, building societies, and you can also get stocks and shares junior ISAs through different investment providers. So now let's talk a little bit more about lifetime ISAs, because these are a little bit different to the other types of ISAs that we've spoken about. So these are targeted for those who are saving for their first home or who want to help bolster their retirement savings. So they can sit alongside a pension, or if you perhaps are saving for a home and then maybe you don't need that money for a deposit for whatever reason, you can keep that money in the lifetime ISA and save it for retirement instead. As I said before, you must be over the age of 18 but under the age of 40, so you must fall into that age category when you open up the lifetime ISA. The annual ISA limit for a lifetime ISA is £4,000 a year. That applies up to the age of 50, so you can't pay in anything once you get to the age of 50. That £4,000 annual allowance counts towards your £20,000 annual ISA limit for all your ISAs, and you must make sure you make your first payment into the lifetime ISA before the age of 40. When you pay into a lifetime ISA, the government give you a bonus of 25% up to £1,000 a year. So that's an incentive for you to save into the lifetime ISAs to help you either buy a first home or to save for your retirement. Lifetime ISAs can be cash ISAs or stocks and shares ISAs, but there are some stipulations about when you can take the money out. You can take it out to buy your first home. You can take it out once you are over the age of 60, so that is classed as your retirement savings. You can also take it out if you're terminally ill and have less than 12 months to live. And if you take it out at any other point or for any other reason, then the government take back their bonuses and you get hit with a 25% withdrawal charge. So that's something to bear in mind if a lifetime ISA is something that you're saving into. Now, ISAs are a really great tax efficient product to save into for various reasons. There is no tax paid on interest on cash ISAs or any income or capital gains you get from stocks and shares ISAs. And if you complete a tax return, you don't need to declare any ISA interest on income or capital gains on your ISA. ISAs have no end date, so although your allowance runs annually from April to April every year, the ISA doesn't come to an end once the next April comes around. It carries on, and it's up to you then to decide whether you want to continue paying into that ISA and subscribe to it for another tax year, or if you want to take that decision and actually say, I'm going to leave that one for now and set up a new ISA. Because you can only pay into one type of ISA per tax year. So for example, this tax year, you might have paid into one particular stocks and shares ISA, but when April comes around, you might say, I'm just going to leave that one now and start up a new stocks and shares ISA. But you cannot pay into both stocks and shares ISAs in the same tax year. You can only pay into one each tax year. You can take money out of your ISAs at any time without any tax penalties or losing any tax benefits, apart from the lifetime ISA that we've just spoken about. But you must check with the bank or the building society or the investment provider that you hold your ISA through if they will be charging you any withdrawal charges. So make sure you do that. Some ISAs are flexible ISAs, and it might not be immediately clear if that applies to your ISA. Flexible ISAs mean that if you take some money out of your ISA within a tax year, you can replace it with the amount that you've taken out, and it won't affect your £20,000 annual ISA limit. So for example, if you had an ISA with £40,000 in it and you decided to take £10,000 out in the current tax year, you could then put another £10,000 straight back into it within the same tax year, and you could still have the £20,000 annual ISA limit as well. So you could effectively put £30,000 back into your ISA in the current tax year. But not all ISAs are flexible ISAs. So if that's something you're keen to make sure applies to your type of ISA, then that's something to check with the bank or the investment provider when you set it up. You can transfer ISAs at any time. You can transfer between the same types of ISAs or between different types of ISAs. And when you transfer ISAs, that does not eat into your £20,000 limit. You could transfer one ISA for example, from a cash ISA to a stocks and shares ISA, and you could still pay £20,000 into that new stocks and shares ISA if you wanted to. If you're transferring money from an ISA in the current tax year, so if it's money you've been paying into a new ISA, for example, in the current tax year, you must transfer all of that money and do a full transfer to whichever ISA you're transferring to. But if it's from previous tax years, you can do partial transfers, so you can leave some money back if you want to. But with lifetime ISAs, if you transfer out into a different type of ISA before the age of 60, then you'll be hit with that 25% penalty. So do bear that in mind. Now, you can only pay into an ISA while you're a resident in the UK. So if you happen to move abroad, then you need to let your ISA provider know, and you cannot pay into that ISA the following tax year after you've moved abroad. You won't lose any of the tax benefits. Your ISA will simply just sit there and it will still keep all the tax benefits that ISAs have, but you won't be able to pay into it again until you return to the UK and become a UK resident again. If you die, your ISA can get sold and the investments can then get paid to the beneficiaries of your estate, or they can be transferred to your surviving spouse or civil partner, but only if you both hold ISAs with the same provider. And it's important to remember that ISAs do form part of your estate for inheritance tax, so they will be included when calculating whether you owe inheritance tax or not when you pass away. If your spouse or civil partner passes away and they have ISA money that you can inherit, then in addition to your own ISA allowance, you actually inherit the value that they had in their ISA, so you can top up your own ISA with the value of their ISA, and it won't eat into your ISA allowance for that tax year. So ISAs are a really great tax efficient way of saving, and because there are so many different types, you can pick and choose which type you want to achieve, what your goal is with this money.